Pennsylvania for the dinner tonight, and I'm actually going to give existing investors a little more work. So if you're an existing investor here with DLP, both if you live in Pennsylvania and Florida or North Carolina, please just give me a favor and just stand up quickly and give you guys a little bit of acknowledgement, and also so the prospective people can see you. There's lots of them around. They're busy eating their salads. There we go. Thank you, everybody. So investor base here is growing. Welcome all you prospective investors as well. And then I'm going to ask one more group to stand up. DLP team members, please go ahead and stand up. Awesome. So these are existing team members. They're very knowledgeable, can chat with you throughout the night. We've just coincidental that we've scattered them across the tables to chat with you here. So welcome. So we're going to go ahead and get started here. Dinner's going to come out. Please do not think you're being impolite. Eat as I present and chat with you tonight. I'm going to try to keep it brief and entertaining as we go through. I encourage any engagement. I'll try to get some of your engagement as we go through. And then at the end, I'm going to open it up to questions. So if you think of questions as we go through, please have them in mind, and we'll go through them. We find a lot of investors tell us the most valuable part they get out of this is the Q&A section, hearing your actual questions. And then I'll come around the room over desserts and so forth and chat with you, as will Larry and the rest of our team. Again, as Larry said, feel free to get up, grab another drink, enjoy yourself as we go through it here tonight. All right, so I'm going to talk to you tonight about a couple things. I'm going to try to keep it a little bit simple, because sometimes if you don't know much about an investment strategy in the world of investing can seem complex and seem like a lot of things, and we as a family of many companies and multiple investment strategies, it can seem complicated. So I'm going to try to keep it a little bit simple here tonight, and I'm going to frame how I look at investing, that there's really two keys to investing, and I think this is true here for real estate investing, but really for all investing. That there's two keys to investing, and this is how I'm sort of going to break down this presentation. Number one is the strategy. So what is the game plan? What is the business model? What are we investing in? Is the first thing we're going to talk about. One first area that's important is a successful strategy. I haven't come up with a better example yet than this. I need to think about a better one, but I always think, if I was going to go in the business of owning large strip centers that I was going to rent out to Blockbuster as my main tenant, right, that probably wouldn't be a good business model to go into today, right, since the video business is gone. So you have to have a good strategy that makes sense and is going to make sense for the period of the investment. And then you need to be able to execute. And execution really comes down to people. So it comes down to the manager who's in charge of executing on the strategy. So there's people who do really well in real estate and people who don't do so as well, and it comes down to that execution. They could be in the right business at the right time, but aren't able to execute well. So those are the two things I'm going to show you tonight, that we have a strategy that makes sense and we're able to really execute at a high level. So we have two main strategies we're going to talk about. I'm going to break it down. We do a few different things, but there's two strategies that you're going to hear about tonight. The first one is we acquire apartment communities. More specifically, we acquire and improve what a lot of people call Class B apartments, and we do that mainly in the Southeast, mainly in smaller markets. And I'm going to show you a little bit more about that. And then our second strategy is real estate-backed private lending. So we make loans to other real estate investors. So that's our second strategy. So we're both an investor ourselves, and we make loans to other real estate investors. Those are the two strategies I'm going to show to you tonight, and the various investment funds that have to do with those two strategies. So the manager is the key to the ability to execute. We're a company at DLP with over 270, now actually over 280 team members, which about 15 or 20 are here with us tonight. We're a vertically integrated operator, as you can see. So not only do we manage your money and invest your money, we do all the operational work then of the execution of property management and construction and sales and the actual lending and so forth, which you'll see. So why should you be interested in investing with us? So I'm hoping I've already sold you on this. That's why you showed up tonight. It wasn't just for this dinner, although the food is good. But I'm going to tell you a couple different reasons. We have three different ways you can invest in these two strategies. One is you can invest in our apartment community investing strategy, which I'm going to show you first, and you'll earn over a 12% targeted annual net return with consistent cash flow and shelter your money from Uncle Sam. Second way you can invest is to earn a fixed return on your investment. So if you heard us on the radio, you probably hear them talking about our fixed returns, 6 to 9% fixed returns on your money. Or the third way is you can invest in our lending strategy, and earn over an 11% return with liquidity. Those are 3 different ways you can invest that hopefully one of those piques your interest. We have a couple principles here at DLP in how we go about investing. They're pretty simple, and they might be a little different than what you would think before coming here, especially when you hear about the returns that we offer. You would think, all right, well, they hear these 10%, 11%, 12% returns. This must be high risk, right? There must be a lot of volatility to this. It must only work if the market's doing really well. So our first principle, the most important thing we focus on in every investment we make is do not lose money ever, period. That's our first, thank you. Yes, that's a big one. So that's our first strategy. We're very proud that in our 12-year history, we have no losses to any investors in any strategy. The second focus for us is consistency in returns. So if you earn a 10% return, but one year it's plus 20 and the next year it's minus 10, that might average to 10, but that doesn't work out to be an effective return of 10. It's very important that those returns are consistent, and we've been able to exceed our targeted returns every single month in every single one of our funds incredibly consistently. And then the third thing we focus on is to generate as high of a return as we can to you, not sacrificing these first 2 principles. So if we can generate 11, 12, 13, 14, 15% returns, phenomenal. But first and foremost is no losses, and the returns need to be consistent. And you'll see that in our track record here. So what do? In simple terms, we invest in people and in real estate. And we say this internally here at DLP as sort of a slogan to what we do, investing in people and in real estate. What we mean by we is us, meaning it's DLP and our investors. It's your money invested alongside our money that's investing in people and in real estate. And to give you a little bit of an example of that, we have over 20,000 tenants right now living in our properties, living in safe, affordable housing, the properties that we own. We currently are helping over 200 entrepreneurs invest and grow businesses, provide jobs, grow communities. We have over 270 team members who DLP supports them and their families, and we generate consistent high-yield returns to you. So those are the things we're generating: great housing, money for entrepreneurs, also helping people find their dream homes, providing a great place to work and income to lots of team members, and in turn returns to all of you. It all works together across our companies. And to put it in pictures, which is a little bit easier to read and see or look at, this gives you kind of some of the examples to what we do. So this is a borrower who we helped flip a home and then sold the home. This is a home that we actually built. This is one of our apartment communities that we own. This is a home that we actually flipped. These are people we help buy and sell homes, and these are a bunch of our team members at some of our company parties who we really help contribute, and they help contribute to our lives. So let's give you a little example of some of the things we do. So to give it a little bit more formal of a presentation, these are the family of companies that we run at DLP. These are all the different operating companies: real estate brokerage, capital management, lending, a marketing company, property management, construction. Good as New is our entity that renovates houses, and so forth. And I'll cover a couple of the other ones later. These are some of the people behind our results. This is our executive team here at DLP. You'll see Patrick, our Chief Marketing Officer, over here. One of our executive team members, Barry, our General Counsel, and also a partner in DLP Capital Partners, somewhere around here. There he is. And a number of our other leaders there. All right, so I told you a little bit about our company and our background. I'll tell you a little bit about myself. So I've been in real estate now. This is year 13. I started in real estate in 2006. It was the peak of the real estate market. When I say it was the peak, it was the top month in the real estate market in Pennsylvania, the month I got licensed. Started as a real estate agent and then started investing in real estate. I've completed well over 8,000 transactions. I've purchased over 1,000 properties, about $1.4 billion in real estate transactions. Today I own, along with you, over 8,000 apartments and homes, as well as some other assets, and we have over 300 loans to other investors right now. We have about $500+ million in assets, and maybe most importantly, I'm the father of these 2 little boys, Donnie and Alex, and my wife here, Carla here. This is at the Jags game, I guess. I didn't know my marketing team put this in here from a couple weeks ago. We live right over there, literally, on that street right there. And our kids go to school here in the neighborhood. So a little bit about me, and I'll move forward here. So more about the company here. This is our purpose: passionately living our dream to create prosperity through innovative real estate solutions. That's our purpose statement. We really live. We have 8 core values that drive our results. Some of you have, some of our investors have actually read some of the books that tell you more about our core values. So one of our core values is grit. There's an awesome book called Grit by Angela Duckworth. Many of our investors have read. Pretty awesome. It's one of our big core values, and we think that's what separates the most successful people from everybody else. One of our focuses and our core values and our purpose and how we operate is we operate under the belief that great companies solve problems. That's really what great companies do, is they're able to solve problems, and in most cases solve problems better than others can. And that's really what we focus on. So I'm going to give you a little, and people have been to a number of these dinners that some of you have. I try to kind of mix up some of our founding stories of how we started on the path that we're on today. And I'm going to show you a little bit about that path and then get into the investments. But this house here is a little house, actually in New Jersey, that a lady came to me. This was her mother's house who had passed away. The lady's name was Cindy. This was back in about 2007 or 2008. And she came to me needing to sell this home. The home was in dated condition and needed some repairs and had been vacant for a year or two after her mom had passed. And she was, not in very good financial situation, really had no money, Cindy, the person who came to me. So we came out, we looked at this home. It needed some basic repairs to make it sellable. We actually put in the money, did the repairs for her, told her you can pay us back when we sell the home. Got the home in sellable condition. We sold the home for her. It sold actually for, believe it or not, this is actually near the Jersey Shore. It sold for $340,000. And probably would have sold for $200,000 if we hadn't put in 10 or 15 grand worth of repairs to make it truly livable. And then at the closing table, when she's getting her check and she was walking away with about $200,000 of cash, Cindy was, which was really life-changing for her. But she said to me at the closing table, and this is back when we just were getting going and investing and managing money, she said to me, this is great, but I don't know what to do. I'm afraid, and again, this is 2007, 2008, I'm afraid of the stock market. I can't get any interest at the bank. Just not know what to do. I'm going to burn through this money quickly. She needed money to live on. So we said to her, well, what if we could pay you a fixed return of 9% and you could lend that money to us? And that's what she did. She invested that 200 grand after a few days of her and her husband talking it over. They invested that 200 grand with us, been earning a 9% return over the last 10 years with us. Actually, they reminded me of this story at our last dinner that they were at. They're still active investors. They've actually invested more money with us over the years. And that was how we started. That's how our first investors came to us. If people couldn't earn returns on their money, were afraid of the stock market, and we had them invest with us, and we would use that money to buy real estate. And that's how we started, offering solutions, helping people sell their homes, helping people earn returns. It was kind of a circle for us, and that's really how we've grown, and each of our companies has come to be, is solving solutions. So from that story to today, we're really proud, as I said before, 0 months of missing any returns. So we've never missed a return target. We have no losses to investors, and we've been very consistent with double-digit returns on all of our equity offerings every year. We've been able to be one of the fastest growing, 5,000 fastest growing companies in America for 6 straight years. What we think is, what makes us really proud about that is, to be one of the 5,000 fastest growing companies is a great accomplishment, of course. Obviously only 5,000 companies out of a few million companies make that list. But most companies make that list 1 time. Sometimes they make that list 2 times. Usually not in consecutive years, because if you grow really fast, and usually you have to kind of catch up, and usually you can't continue that pace because they judge your growth over 3 years. We've made this list 6 years in a row. We've averaged 308% growth over a 3-year period on average each of the last 3 years, over 9 years now. So even as we've grown and we've launched new businesses and we've expanded, we've maintained a very steady, consistent pace of growth. And that consistency is what delivers the consistency in our returns to you. We continue to do the things that worked for us 10 years ago and continue to build upon them and launch new sectors of our business. A snapshot of us today financially, we have $565 million in assets under management. We have 8,000 apartments and homes that we own, over 300 loans. We're about to have our 7th investment fund. It'll be live any day. We have about 500 investors. And again, 0 losses, 0 months missing returns, 270 plus team members, close to 300 actually now. And we do about $100 million in annual revenue in our operating companies. Where we're going to be in a few years, by 2022, we expect to go from $565 million to $2 billion. So people often say, well, Don, why are you buying us all dinner and bringing us out here? You've already done all this. Why, what's the goal? We're still growing. We're still really getting started. We're going to be 4 times our size in about 4 years, which might sound really fast. That's what we've averaged for the last 10 years. We're just continuing that path of growth. We'll have over 1,000 loans. We'll have over 1,000 investors. And we'll own somewhere around 20,000 apartments at that time. This here, you probably can't read it. It says, the company simply must be doing something about the office space problems. They have people sitting outside because they're growing so fast. And funny enough, Rick, who's our new senior asset manager in the back of the room, just started today in an office and doesn't have an office yet because we're literally running out of office spaces. We take over the 2nd floor of our building in a few weeks to solve that problem, but we're continuing to expand. So I'm the look hard at so you can shelter that income. So what we buy, again, is apartment communities, 200 to 500 unit apartment communities predominantly, what are called Class B, which I'll describe, and mainly are value add, meaning they need improvements. They're not running that great now. Often they need physical improvements, etc. So I don't know why this was the picture that was chosen, but this is our most recent acquisition, and I'll explain why. I don't know why that's the picture, but this is a 6-story apartment community on the water in Titusville, Florida, that overlooks the launch station, where they're shooting off 1 or 2 rocket ships every month. That whole area is exploding. So it's a really cool property right on the water. Our first mid-rise building with a lot of opportunity, but it's 100% vacant. It was damaged through Irma and needs renovation. But it's going to be a big opportunity for us, and we should have shown a picture of the space station as would have been a cooler picture, but it's a very, very cool property for sure. We're going to probably come back to that a little later, Investor Spotlight. These are some of our communities we own. So that's the community right here in Titusville, Florida that I just showed you. But these are in your brochures. We have our apartment communities listed from largest size down through smallest size here, all throughout, as you'll see again here on the map, I guess not, but all throughout the Southeast. So our most active state is Georgia, then Florida, South Carolina, North Carolina, Mississippi, Alabama are the states we've been very active in. So how do we go about being an effective manager in this strategy, and how do we go about mitigating your risk? There's a few ways we do that. So first is strong in-house management, meaning property management. So these are our leaders who oversee property and asset management, including Rick, who's in the back of the room, our new senior asset manager. Mary runs operations, Amy runs front of the house, Hank runs all the capital projects, and then our regional property manager is responsible for the various regions that we're in, that we break out our portfolio within. And then these are the leaders who oversee the construction side of our business and help oversee all the renovations and redevelopment team. They're all located out of Pennsylvania, other than Carlos, who happens to be on here twice, so he's special. How we mitigate risk above and beyond having strong management is first and foremost, I think, is disciplined buying. So that's a hard thing to do in a really good market like today. People are arguably, and it's arguable because property values keep going up, rents keep going up, but are paying too much right now. People are buying these types of apartment communities we buy at 5 cap rates very often. Who here knows what a cap rate is? A few? All right, most don't. So a cap rate, it means if you bought the property, so if you bought a property for $1 million, all cash, you didn't take out a loan, how much would you earn each year from rental income? What would be your cash flow off of the rents? So if I bought a property for $1 million and I had a 5 cap rate, that means I'd be earning 50 grand a year off of that property. That's pretty common right now in the multifamily space. For us, we have to be able to generate an 8.5 cap rate by our second year, which means we'd have to be able to get 85 grand on $1 million investment instead of 50, not factoring in the leverage. So it basically means we need to buy properties at 20, 30% better pricing, lower pricing than what most people are paying. So there's a lot that goes into being able to do that. I'm going to show you a little bit of that. But we don't get emotional on deals. We don't get tied into deals. If the deal makes financial sense, we buy it. If it doesn't, we don't. And we underwrite hundreds and hundreds of deals every month to buy 1 or 2. This will begin to be probably hard to read, but this gives you a breakdown. Again, it's in the brochure of the types of properties we buy, where, how we financially underwrite them. Another way we mitigate risk, and maybe the most common question people ask me about investing in real estate today, the biggest risk people seem to think about, is interest rates. We all believe, I think, or most of us believe, interest rates are going to go up. I believe that that's the case. So I often get the question, what happens if interest rates go up 2% or 3%? Won't that affect you a lot? And it certainly will have some effects, actually more positive than negative, we believe. But what's really important is when we buy properties, we lock in our loans usually for 7 to 12 years, meaning the interest rate can't change over the course of our investment. So our interest rate's locked in. So if we lock in our interest rate at 4.5% and 2 years in interest rates are 6%, it doesn't affect us. Actually, in some ways it benefits us because it makes our loan an asset because a borrower could assume our loan. So it actually is a benefit. So we really focus on that. And then our loans are non-recourse, meaning the bank can't come after us or you or anybody if we didn't pay. Of course, we would always pay our loans, but there's no personal recourse attached to the loan, which is always a good thing. This chart here gives you just a little breakdown of what it takes for us to go about mitigating risk and buying a property. So every month, Jack and Anthony mainly, Jack's over here, and where's Anthony at? Anthony's in the back there, our Director of Investments. They're looking at 300 to 500 deals, and then Ken over here is out in the field walking lots of these properties. He's our Senior Acquisition Manager. So they're looking at hundreds of deals every month. They take 40, 50 deals that Jack spends endless hours, and I mean, I see him Sundays, afternoons, weeknights in the office at 9 p.m. in there running analysis on deals, underwriting the markets, etc. So we take about 40, 50 deals every month that we're diving deep into, that we're really interested in buying, that we think we could have a chance at buying. And then 20 or so deals we're diving even deeper, and we're getting out and physically walking the properties and looking at units. And then we put out, and we do walk through every apartment, and we tear the property apart, we talk to the police station, we walk the competing communities, and we go down to the codes office, and we end dollars underwriting a property to many times not end up buying it because it doesn't meet the standards for our returns. And that's the effort it takes to buy 1 or 2 deals a month, and that's how we're able to get these kind of deals, is because we're willing to invest this kind of time and energy that most aren't able or willing to do. Again, here's our little marks to where our communities are located. We're under contract right now to buy 4 communities in Baton Rouge, Louisiana. We're under contract right now in South Bend, Indiana, Augusta, Georgia. So we're expanding. We're already in Augusta, Georgia. We're expanding into some new markets right now. So we buy properties, we buy them at good deals, but then we still come in there and we add value. So what I mean by adding value is we come in there and do a number of things. First is we do improvements, physical improvements to the properties. So we're often coming in there and renovating and upgrading apartments, adding amenities, improving management. So this is a picture of an apartment that's under renovation literally right now that we came in and had to renovate from the studs and completely redo. I'll give you a couple kind of examples. This is a small property that we bought in Pennsylvania, in Nazareth, Pennsylvania. It was 9 apartments, and this was just a couple years ago, that had the bathrooms across the hall. So literally you had to share your bathrooms with other tenants. And then it had a laundromat and a tattoo parlor on the first floor. It was a really, really great base of tenants. It was really, really nice. So we came in there and we vacated the building. We gutted it down to the studs. We converted it from 9 apartments and 2 commercial spaces to 16 apartments. And this is what it looks like now. Completely redid the facade. Every apartment looks like that. Took the rents from $400 a month to $1,000 a month. And it's a great property now. It's again a little property, but an example of some of the heavy lifts that we've done. This property here is a Cardinal Apartment community, which is the type of property that Megan and Janet work out of in Orlando. We own 10 communities that look identical to this, single-story apartment communities that were built by a builder out of the Midwest who built about 500,000 apartments in a factory very similar to these in the 80s mainly. And often we come into the apartments, they look like that. They have, we call them not mold, mildew issues, really rough shape. So we'll come in and we'll clean up the outside, landscape them, and then we'll renovate the apartments. Hard surface flooring and new cabinets and new lighting, and we'll take a rent from, believe it or not, we buy a lot of communities where the rents are $400, $450 when we come in, and increase that rent to $600, $650, $700, etc. And attract much better tenants, keep them better, keep our maintenance costs down, safer communities, etc. Here's a before picture in Brunswick, Georgia. We came into this community and 40 apartments were completely gutted like this, completely down. They hadn't been touched in 10 years. And we came in there and renovated all 40 of them, and now they all look like this. So we're willing to do the heavy lifting to generate returns. Very often when we're putting money into a property, we're putting $10,000 into renovations, we're getting a 20+% return on investment just from cash flow. And often that $10,000 investment is increasing the value 30 or 40 grand. It adds huge value to all of us. Here it says how we add value. A pool would add value if, and of course, digging it we found bones. More is the better. I hadn't read that joke before, so I'm reading it here with you. All right, so why we invest in multifamily, or maybe more general, why we invest in rental housing. So who here is surprised to hear that rentership is on the incline, that more people are renters today? Some of you? So rentership's growing and homeownership's going down. That's been the trend for 10 years now. Most quote-unquote experts or economists expect that to continue. We went from nearly 70% of America were homeowners to now about 60%. That might not sound significant. That's about 20, 30 million people. And many expect that to continue. Many of the younger generation came to age during the greatest real estate recession maybe in history. It's not the same desire to be a homeowner as it once was for many. And also we're a more transient society, right? People aren't staying at jobs as long. They're not staying in locations. They want more flexibility. So rentership is on the rise. Homeownership is on the decline. Not only are people choosing not to rent or not to own, but also when they do decide to own, they're doing so later in life. Take a guess at when the average age somebody gets married today and has their first kid. It's about the same age. Take a guess. 28, I heard? 32? 40? See, you beat it there. 37. Yeah. So most people don't buy a home until they get married and have kids, right? I mean, that's the typical. So that's happening much later in life. So it's keeping people renters much longer. So those are some of the macro reasons why we like rental. Why we like multifamily. Oops, I went backwards. Why we like the Southeast, most of our investing is the Southeast, is because there's great job growth. These are pro-business states, great job growth. Lot of workforce housing type, manufacturing type jobs throughout Georgia and South Carolina and North Carolina, these areas. So great job growth, great population growth, and we think that's going to continue. I mean, now that people have the option, there's more flexibility to how we work and where we work, people are going to continue to choose to move to warmer climates, right? Who here used to live in a colder place, right? So shouldn't be a surprise to you, right? It's crazy number of people moving to the South every day. I don't remember the stats offhand, but huge. So what that means to us is there's more demand. So if there's more people, there's more jobs, there's more demand. But what's really great is even though there's more demand, there's not more product, especially in the markets we're in. So we go into what are called secondary or tertiary markets. That means we're not going into generally, not that we wouldn't, but we're not going into Miami or Atlanta. We're going into our bigger markets. We're in our Orlando or Jacksonville, but we're going into the Augusta, Georgias, the Columbia, South Carolinas, the Warner Robins, Georgias, the Jackson, Mississippi type markets where there's less competition. We can get stronger returns. And then we also like having geographic and market diversification where our portfolio is not affected by one major market, one major employer, et cetera. And why we invest in the Class B space, which basically means not luxury apartments. So here for many of you, I'm sure, live somewhere around this area, somewhere near Jacksonville. Who's noticed a lot of apartments being built in Jacksonville? Right? Everywhere, right? Most markets are like that. Thousands and thousands of apartments. I think it's about 6,000 apartments under construction right now in Jacksonville. Take a guess at what the average one-bedroom rent is. $1,000? $1,800? $1,500? 2,000? Yeah, so it's some of you are pretty darn close. $1,500, $1,600 a month is the average for a one-bedroom in Jacksonville. Anybody look at the types of jobs that are in Jacksonville? Right? Does that really make sense? Most markets are like that. The only product that can be built cost effectively is luxury product, Class A product. Really nice modern properties that you have to charge $1,500, $1,600, $1,800 for the project to work. Yet most of the jobs are $40,000, $50,000 jobs. You can't afford that kind of rent. Landlords in the Class A space, I'm seeing use 40% of your gross rent to qualify for the apartment. That means more than half of your net income goes towards your rent. How does that work? Right? It doesn't long term. So we think when there's a market correction that because there's no new product, lots of new demand, and then when there's a market correction, people are going to be forced to sort of come back to reality and live in a place that they can afford, that there's going to remain very, very strong demand and strong rents in this affordable space. The Class A space in markets that get overdeveloped are going to have some problems, we think. We think there'll be some great investment opportunities then. We'll be interested in buying those properties then when they're at major discounts. But to build them or invest in them right now, I think that's where the risk is. This affordable space, there's not a lack of tenants ever in this space. And even in the 2008, 2009 timeframe, this Class B space in most markets maintained its rents or increased them and maintained their normal occupancy or increased it. So we feel very confident it's a great place to be for those reasons. Who wants to take a guess at how much rents, and if you're one of our existing investors, you just heard me say this, please don't shout it out. How much do you think rents have gone up in the last 10 years, last decade? Since the great downturn, right, since 2008, how much do you think rents have gone up? 100%. 100%? Any other guesses? 100? 50? So about, depending on which market you're in, 54, 55% is what rents have gone up in a decade. So if an apartment was $700 a month, now it's $1,050 a month or $1,100 a month. Who thinks incomes have gone up 50% over the last decade? Right? They haven't. So that's a big benefit to this space. We don't model that it's going to continue that way, that's continue to grow that way, but that's what's happened. Rents have gone to the point where everything being built is skyrocketing rents and the incomes aren't there to support it. So it's going to force more people to be in the affordable housing space, the Class B space. And again, we think when market corrects that rents and occupancy are going to do very well in this space. So this is an example. Some of our existing investors saw me go through this. I'm just going to give a couple of highlights on this. This is one of our most recent investments. This is a 300-unit apartment community in Valdosta, Georgia, about 2 hours from here, that we bought in end of July. These are some pictures of the community. So this is a Class B community. Has a little park, has a pool, has a little fitness center, nice apartments, nice place to live, great landscape, or great mature landscaping and trees, little park right next door. We think it's a really, really great property. We paid $38,000 an apartment for this. To give you an idea, to build a new comparable sized unit would be $150,000 to $200,000 depending on the market you're in. We bought this with expectation. The yields look really high there if you can read them, but we'll be able to produce double-digit cash-on-cash returns to investors. And our expected yield on this investment over 5 years is 23.7%, assuming the market actually gets much worse than it is today. And these are some examples of what the apartments look like. So they're in pretty good shape, most of them. About 20 apartments were down. They needed full renovation. But then a lot of them will come in and will update these counters and reface the cabinets and get rid of the carpet. We hate carpet. Get rid of the carpet and put in hard surface flooring and modernize the lighting. And we'll increase the rents $150, $175, but they'll still be affordable. A one-bedroom apartment in this community right now is $560 a month. We'll get those rents to $775, still be affordable, but increase our returns pretty dramatically. All right, so that strategy. How do you invest in this strategy? It's our preferred return equity fund. This is our third equity fund. The preferred return is 7%. That's how much you earn before we earn anything. We don't even earn our management fee until we pay you that return. Our goal is to distribute to you 8 to 9% returns on an annual basis, paid out quarterly. So in simple terms, 2% return, 2% dividend on your investment every quarter. And then the overall return goal on this fund, which will be a 5 to 8 year fund, is at least a 12% annual net return on your investment. Those are the net returns to you. And historically, we've drastically exceeded these types of returns for our equity strategies. But we know there will be a market correction over the period of this fund. So we've tried to be very conservative in how we look at deals and in turn how we underwrite the return. So, for example, we're buying properties that we model at a 23% return, but we're only targeting 12. It's only, but we're targeting 12. Again, distributions are on a quarterly basis. At the end of the fund, our expectation is essentially to return back to you 2 times your original investment, plus you were earning 8, 9% each year. So I'll give you simple numbers. You invested $500,000. Our goal is to distribute to you about 10 grand every quarter, about 40 grand a year. Most, if not all of that, will be deferred from tax, meaning you won't pay income taxes this year on those gains. And at the end, when we give you back 2 times your original investment, now you'll pay long-term capital gains if you don't move your money into another vehicle that can continue to defer tax. All right, so that's the first strategy, and I'll answer a question on that. And I'm going to go a little bit faster through our lending strategy here. Our second strategy is private lending to real estate investors. So we lend money to active, professional real estate investors who buy single-family homes and who buy apartment communities. This private lending business is now $62 billion. Basically, banks have gotten out of a lot of real estate lending and certainly have gotten out of short-term real estate lending. So there's a need for this private lending space because there's a big demand. Banks have gotten out of this space. When people are buying short-term deals, who here has ever flipped a house? All right, so let me have, okay. You need to close fast. We're in a country with an aging housing stock, so homes are getting dated, in need of renovation, so there's a lot of opportunity out there. This says we loan to not this person. It says 12,000 Twitter followers, 25,000 subscribers on FeedBurner are certainly impressive, but they aren't what we're banking business called collateral. So we're not using the dreams or good ideas as collateral. You know, we're lending against hardback assets to experienced real estate investors. So to give you that in specific numbers, our average loan to value is 55%. Actually, I think right now it's about 53%. Our average loan to cost is 73%, meaning the borrower put over 27% of all the purchase money and all the renovation money out of their pocket. On our average loan, the borrower has about $60,000 to $70,000 invested, plus makes the loan payments every month, plus pays taxes and insurance every month, plus pays the utilities every month on an average house. They have real skin in the game. We focus on lending on single-family and multifamily properties. We do not make any loans to homeowners, meaning that we don't lend on their home. A lot of them own homes, of course, but I mean we don't lend to them on the home that they live in. We only lend on investment properties. Our borrowers go through a financial and credit analysis. Our average borrower has a net worth of about $2 million. Our average borrower has liquid cash of $200,000 to $400,000 and has nearly a 700 average credit score. So they're good bankable borrowers, but they need fast, flexible money. We go out and physically inspect every property. So we go out there and send an inspector out. We send an appraiser out. We take pictures. We evaluate the scope. We do real due diligence on every property in addition to doing due diligence on the borrower. This is an example of a typical house they come into. It's in need of renovation. This one had a gutted bathroom and some gutted living space, a dated kitchen. This is an actual loan. So this borrower was an experienced flipper. They had a 756 credit score, had a net worth of 600 grand. We gave them a loan for 180 grand on a house worth 305,000. Our interest rate was 13.99%. It's a little higher than our normal. This is what it looked like afterwards. They came in there and redid the kitchen, redid the whole house, and did a great job. This is another example. This is a dated foreclosed house, little house. Borrower, I guess this was the same borrower. Yeah, I guess it was the same borrower. $50,000 loan amount on $127,000 value, and this is what it looked like at the end. They did a really great job. They fully staged the house, put a cool kind of fireplace in it, really kind of modern kitchen. Really did a great job. They sold it for $127,000 in under 6 months, which made our loan, 30-some% of the value. It would be so easy to flip this house, is what this says. So, we're lending to real investors who know what they're doing. All right, so how do you invest in this strategy? You can do so in the lending fund or the income and growth fund. They're two very similar funds. They're evergreen funds, meaning they're open indefinitely, but you can take your money out with just 90-day notice. So they're very liquid. We have a preferred return of 10%. That means you earn 10% before we earn anything, and a goal of generating at least 11% to you. So minimum of 10 before we get to earn anything, and then a goal of at least 11. In our lending fund, which is started in 2014, we've averaged 14.4% net to investors. So I know it's kind of hard to read, but hopefully you can see the colors. The light green is the target return. The dark green is how much we exceeded the target return. Every month we've exceeded the target return month over month for an average of over 14% over the last four years or so. And then our income and growth fund, which is very similar, has the exact same return targets. It's at a slightly lower average return, but we expect looking forward, it's going to do the same as lending fund or maybe even slightly higher. The difference between the two funds is pretty simple. The lending fund only makes loans to investors who are not DLP. The income and growth fund makes loans to investors and to properties DLP owns. So we can be the borrower of money in the income and growth fund. We're not the borrower of money in the lending fund. Some look at that as a positive, some not. It's a sort of a personal opinion, but they both do exactly the same thing. And then the last way you can invest with us is as a note holder. So you say to me, Don, this all sounds great. I know you've generated good returns. I know you haven't lost any money, but I really don't like risk. What's your lowest risk option you have? That's our note offerings. So in our note offerings, it's pretty simple. You choose to invest and just commit for 90 days, 3 years, or 5 years. So you choose that commitment period. You choose how much you invest. So we have it broken down in categories, 100 to 250 grand, 250 to $1 million, and $1 million plus. So based on the amount of money you invest, the amount of time, that's your fixed return. You choose to take distributions every month, or you can let it compound and grow. You can do a combination of both. You can switch at any time, and that's a fixed return. We're signing a contract guaranteeing that return. It's not guaranteed by the FDIC, but we're obligated and we're guaranteeing your return. So you're going to get a fixed return distributed on the first of each month or sooner. ACH right into your account is how 99% of people have it, and you'll know what your income is going to be. If you don't need income and you want it to grow, you can sit there and take out the calculator and know exactly how much money you have in this fund in 3 years. Because there's not $1 of expense that comes out of this return, not one fee, not anything. You invest $100,000 for 5 years, you're going to earn exactly $7,000 a year. It'll compound monthly if you let it reinvest, but you're going to earn exactly that much. Not a dollar comes out of it. And then if you let the returns compound and grow, this shows you what your compounded return would work out to be. So as an example, if you invested $100,000 and didn't take the money out, you would earn, in this shorter investment in 1 year, you'd earn $6,170 if you didn't take any money out in the year. It's exactly the amount of money, not a dollar comes out of it. You can invest via an IRA. So it says this is our retirement plan. So if you're thinking about retirement, you have IRA funds, old 401ks, you can invest through qualified money with us through either a self-directed IRA or you can custodian with a Charles Schwab or a Fidelity and invest that money with us through an IRA. Oops, went backwards. Know what you're thinking? Wow, this sounds so great. So what do I do now? So if you're interested from here, we don't have any paperwork with us, although our office is across the street. And we're not here to take any commitments today, just to give you education, but I'm going to open it up to questions and answers now and answer questions you have, but then you can meet with myself, Mike, Larry. We can dive into your specific situations and goals and help you to determine if any of our strategies make sense for you. And we'll send you a login to DLP Crowd if we haven't already, so you can on your own time in your pajamas at home do due diligence, do research on us, look at how we invest, and get comfortable with it on your own. All right, so I'm going to open up to questions. After questions, and feel free to go ahead and grab drinks and so forth. I know most of you have been sitting patiently. We're going to do a raffle and talk about upcoming events, so don't leave, because we're going to give away literally $1,000 of real cash. So hang in for that. We're going to give out 2 winners. But I'm going to open up to questions. So thank you, everybody. Yes? Do we have a second mic?
She's always got a question.
Oh.
Do you raise the rent every year on your low-income housing?
The question was, do we raise our rents every year? Short answer is yes. We raise our rents pretty much, every month in general. I mean, we're not raising the rents on the people living in the units, but on new tenants, we're steadily increasing our rents. And then at renewal, we're often increasing rents. So we're keeping with where the market is on rents, yes.
Okay, I have another question. Okay. Now, on all the properties that you acquire, are you the one that has the final say-so on what is bought and what is not bought?
So short answer is yes. The longer answer is we have an investment committee. We meet every Tuesday at 3:30. It's myself, Bob, our CFO, Barry, our general counsel, Anthony, our director of investments, Jack, Ken, Jason, our COO, Nate, our head of lending, and we all meet and we go through each of our investments. Anybody can turn down the deal, anybody can deny it, and that's what happens is most of the deals before they get to that point, somebody didn't like the deal for a variety of reasons and we don't buy it. But I have the final say that I have to approve it. Anybody can basically not move forward the deal, but I have to approve the deal to move forward. And that's every loan as well. Every single loan we do, I sign an approval memo and do a final sign-off, review all the risks and mitigants and the details on every single loan we do, which is 1 or 2 often a day that I'm going through and underwriting. So and that's after Ed, who's our credit analyst somewhere around here. I don't know where Ed is. Oh, on the back there. So he goes through, puts together the mitigants. Our processing team, Joni, puts together a lot of the details, goes through the appraisal, evaluates a bunch of people. Probably 6 or 7 people underwrite the deal, screen it, evaluate it before it gets to me, and I look it over and have to give a final sign-off.
Okay, I have one more. Okay. Now, you said that we'll get our money before you get yours. Well, how are you making money that way?
Well, because we always give you your money. That's the short. So we've never missed our return target, so we've never had the situation where we haven't earned a return.
Okay, thank you.
Great questions. So a hand back here.
Were you in business when the real estate bubble burst? And if so, what happened?
So yes, the short answer is yes. We started in 2006, which was the peak of the real estate market. So our first 5 or 6 years investing, the market was going down. We were flipping houses and investing. Now, so we did very, very well. We think in the downturns are the greatest opportunities. Really the biggest risk for us that we see in the next downturn is you. And what I mean by that is your confidence in keeping your money invested, because when the market's not doing well, we all tend to, we know we do, right, get nervous and want to put your money under your mattress, right? That's when actually there's amazing opportunities. So we're really excited for the next opportunity to buy and to invest more. We did not have $500 million portfolio through the last downturn that we managed through, so it's a little different situation, but we know it's coming. We know it'll be here soon. There'll be some level of correction, and we're very well prepared for it, and that's why we invest in these types of strategies that we do. So I kind of skipped on the lending business, how we mitigate risk a little bit, but low loan to values, low loan to cost, lots of skin in the game, and then also our loans are 6-month loans. So we're not stuck in loans when the market's going down. But most importantly is skin in the game. So I'll give you, and I usually have this in there, I took this slide out, but I think it's a really powerful slide. In the last downturn, take a guess, and existing investors don't say it, how many homes were foreclosed on through the last recession? You want to take the guess?
No guess.
Who has a guess? Throw out a guess, any number. How many homes do you think were lost to foreclosure from 2008 down through 2012?
100,000.
100,000. I can't hear you back there. 10 million?
Several million, probably.
Several million? Yeah, so it was actually right around 10 million homes that were lost to foreclosure. Okay, so out of those 10 million homes that were lost to foreclosure, take a guess at how many put 20% down? None? Zero? 20%? Less than 10,000, so less than 0.1% put 20% down. So if you knew those facts, which I promise you all big banking knows those facts, you would think it's not that complicated of a formula, right? What would you do differently this time? Come on, shout it out. What would you do differently if you were lending today? Bigger down payments, right? So that's why we know that's so important. That's why we haven't lost money on a single loan. It's because we require cash in the game, skin in the game. Yet guess how much money the average borrower puts down today? 5%? Close. 3? Yeah, so the most common loan people take out today is FHA financing, which is 96.5% financing, plus you can roll 6% closing costs in, so you can actually take a loan for 102.5% of your purchase price. That's the most common loan done today. So that's what banks lend on at 4 or 5%. We're lending on 27% cash invested, 45% equity to experienced investors. So those are some of the big ways where we feel we're really well prepared for the next change. Great question.
Two questions. For all the 3 or 4 different investment vehicles that you demonstrated, do you have to be an accredited investor for all of them? And then second question is the only investment that is tax advantaged the first of the ones you introduced?
Great question. So first question was, do you have to be an accredited investor to invest in all of these strategies? So an accredited investor, if you're not aware of that term, is somebody who has $1 million in total net worth, not including your personal home, or a $200,000 annual income as per your tax return adjusted gross income. So that's the definition. So to invest in any of the funds themselves, yes, you have to be an accredited investor. We do have one vehicle available, and this is how we started. That story I told you, that lady who invested her proceeds with me 9, 10 years ago, it's what she did, and this is something we still do today, which is the private notes. So you can do a private note. It's not within a fund, but basically you're lending money to us that we use to buy houses and apartment communities. But you're lending to us to use that money. We're borrowing that money to buy real estate. So that's something we do for people who are not accredited. It's not within a fund structure. It's just a private note, private investment. You're essentially lending money to us. And we've been doing that for over 10 years now. Next question was about tax advantageous. So out of everything I showed you there today, yes, the only strategy that is tax advantageous that has the benefits of depreciation is the multifamily investment strategy, the first one. The other strategies, you're taxed at ordinary income. Unless two things. Unless either A, you're investing through an IRA or a 401k, of course, then you're getting the shelter of it, of tax. And then very soon, I didn't put it in the presentation because it's not ready yet, but within the next 6 to 8 weeks, we expect to be live on a new fund, which is going to be what's called an insurance designated fund. And the really short version of what that means is you'd be able to invest in our lending strategy within a life insurance or an annuity policy. And that even means if you have an existing insurance policy or an existing annuity, you could do what's called a 1035 exchange. You could roll that over into our fund and now earn strong, consistent return versus probably, I'm just guessing because 99% of annuities and insurance policies out there over the last 10 years have drastically underperformed the projections, probably hasn't been doing very well. Or if you had new money that wasn't an insurance policy, you could invest that money within this fund, open an insurance policy, and now your money's sheltered from tax, and you're getting the benefit of an insurance plan, which for some of you might be valuable for estate planning and so forth. So soon we'll have another vehicle that you can invest in our lending strategy, sheltered from tax, but it's not live yet, but it will be soon. Great question. Next question. This is Larry's wife, Jen.
It's the same question.
All right.
Charitable giving.
So she asked me this question last time too because I skipped over it and I didn't add it back in the presentation. So her question was about charitable giving. So we have a foundation called the DLP Positive Returns Foundation that we launched on January 1st of this year. And this fund, first, one of the cool things about this fund is our next fund that's going to be just a note-only fund. It's going to be called the DLP Positive Returns Fund, and Barry hopefully will tell me it's going to be live next week. Any day, we're waiting on SEC approval. It'll be a fund where you just get a fixed return on your investment, but one of the cool things about that fund is our 1% management fee we earn is all going to be donated to the foundation, our first year management fee on all the money we invest. So our goal is to raise $100 million over the first year and a half in that fund and donate, that'll be $1 million that we put into this foundation. In addition, we put money in for a lot of other reasons and a lot of things we do. But our focus of the foundation is two things. One is affordable housing. So I believe as much as we talk about it from a business perspective and how we can make great returns and why it makes sense as an investment, it is an epidemic. I believe it's one of the biggest epidemics facing the country is that there is a lack of affordable housing. Incomes are not keeping up with housing. They're not building housing that people can afford. It's a problem because you can't afford to build something that people can afford to live in. So it's a major problem. So we're focused through the foundation on affordable housing. And we partner with an organization called Good Works, one of the first groups we partnered with, where we actually help people who live in homes but they need repairs. They can't afford to do the repairs. We actually come in, do the repairs for them. All the labor's free, all the materials are donated. And then it's a faith-based organization that also provides guidance and counseling and ministry really to the people as well. Because usually when they're in distressed situations, living in uninhabitable homes, usually there's something else challenging them as well. There's depression or some other issues. There's a really amazing organization in Pennsylvania that's expanding into new markets. And then the other thing we're focused on is the jobs epidemic. So all the political rhetoric, and I don't like to get into politics so much, but it's always about, we're losing our jobs to overseas. Really, we're losing our jobs to technology. And they estimate Amazon will delete 1.5 million jobs this year alone, right? Just through their centralizing of so many things. And I love Amazon, right? They're at my house every day. My wife will attest. We all love Amazon, right? But they're getting rid of a lot of jobs because they're streamlining and replacing things with technologies. Go try to find pictures inside an Amazon warehouse. They're hard to find because they don't want to show you. There's hardly any people in them compared to the amount of business they do. There's 2.3 million cashiers in America. There'll be almost none of them in just a few years. Where do those people go for jobs? How are they going to be repurposed? So I believe the only way to solve for the job epidemic is through entrepreneurship. It's through creating new types of jobs and new companies here in America. So that's our second focus is helping grow entrepreneurship. In a few different ways we're focusing on that. So that's what our non-for-profit side of our focus is, that you investing with us help us to support. Thank you, Jen. Other questions?
You described the various funds, and the fixed investment fund has the least risk. Could you briefly describe what is the enhanced risk with the other funds that I would incur if I invested?
Yeah, absolutely. So I'm going to give a simple example of this that hopefully make it somewhat easy to understand. So let's say the income and growth fund, I'm going to simplify the numbers a little bit because the private notes are usually done in the income and growth fund. So if the income and growth fund, and the numbers are actually in real life bigger than this, but I'm just going to simplify. The income and growth fund had loans against $10 million worth of real estate. The income and growth fund would lend about $6.5 million. Okay? So that means there would be $3.5 million in equity in those properties above our loan. Right? 65% of the value is what we would lend on average. It's actually a little less than that, but that's on average. So meaning the borrower would put $3.5 million of their own money and creating value as well within that property. So out of the $6.5 million of investor capital, of our money invested against those $10 million in properties, currently only about 10 to 15% of that money is investors in note holder position. So to use that example, real estate's worth $10 million, the income and growth fund invests $6.5 million, the note holders invest $1 million. So what that means is in order for a note holder to lose money, the real estate would have to drop in value from $10 million down to $1 million. It's not that likely, right? And all the borrowers would basically have to go bankrupt, and so would we, because the borrowers are signing personal guarantees as well. So in really short, the borrowers have to lose all their money, the real estate has to lose all its value, and all the equity investors have to lose all their